All right, good afternoon, everybody. Event Trader here. As you saw, we're going to be joined by, I think I heard him coming in. Is that you, Robert?
Yes, I'm here.
All right, we're being joined by Robert Reed, who, of course, is our senior analyst over on the Briefing and Play Plus product. Robert, for years, has been developing the GrowX names for us and doing a good job in getting people out in some of the hotter names in the market. So we're going to bring Robert on to discuss a couple of names that are currently on his focus list. So, Robert, how are you doing today?
I'm good. How are you doing?
Doing good. Anything that you're seeing out there in the markets of interest to you outside of the names we're about to discuss, sir?
Well, I was going to talk about, there's a couple of new ads on Emerging Growth this week, and then I was going to talk about Brinker International is kind of a name that, the other two names are a little bit stretched in the near term. I'd probably wait for a pullback, but the Brinker name is one that I think I'd feel comfortable buying here. I think it's a nice turnaround play, and there's been a lot of share buybacks in the name, which I'd like to see. It's actually number one in our yield leaders report that was published earlier today on the Bit Plus product. So,
Okay, nice. So we're going to start off with those ads in the GrowX, which is in the emerging growth stocks, which of course anybody could find if you're looking to follow along and check out the emerging growth list. It's under the investing and trading ideas area. You can see under fundamental, it's the first drop down menu there, and with that you can see the additions that Robert has put in for the week, as well as the deletions, and then the list of the 50 names that are currently on this list. So Robert, one of the ones, as you mentioned, that jumped on here is a name that I know Scott and I have been talking about for a little bit now. Obviously in a great space and seeing a lot of upside with regards to that, but why don't you give people a little backdrop on what AeroVironment, ticker symbol AVAV, does?
So AeroVironment, they're a supplier of unmanned aircraft systems, UAS. Think of it as drones, and also for tactical missile systems. They do more of the smaller type drones, not the humongous ones that the bigger defense companies do, but they're the big player in the small segment of the drone market, and their primary customers are the U.S. Department of Defense, also, and they also for some allied defense countries as well, and they're also kind of branching into the commercial market, which I'll get into in just a little bit.
Robert, do you know, are any of these 10% customers, do you know offhand?
I believe certainly the Defense Department. I think it's around 50%. So that's a big chunk of their business for sure. Is the U.S. Department of Defense, and that would include obviously Marine Corps, Navy, Air Force, all the areas. So all of that combined would be up 50%. So yeah, there's definitely a big part of their business.
All right. So where's the primary growth been coming from?
Well, it's mainly been their drones. They've unveiled quite a few new drones that have done really well, and they've been accepted by the Defense Department with open arms. So it's really been, a lot of it's been new product innovation that's been exciting, because as these drones get lighter, they get more sophisticated, their sensors get more sophisticated, their video capabilities get more sophisticated. It just drives more and more demand for them, and these are the kind of ones where people can just carry them around with them on the ground, throw them up in the air, and they can get a good visualization of what's around them. So it's kind of how the Army sees itself going forward, as sort of like on a light footprint, but they need that intelligence gathering right there on site. So that's why these little drones are really helpful. So basically, they're just seeing a lot of interest there, and they also sold off. They actually had their efficient energy systems, or EES segment, which did I believe that was more into the the hybrid plug-in market, but they sold that off, which I think was a good move. They're focusing more on, so now they're a pure play unmanned technology provider, and they're saying they're focused on robotics, sensors, software analytics, and connectivity. So they're basically more focused on the growth areas. And also there's also the tactical missile systems, which is another big part of their business, and that's doing well also. So overall, it's just everything's just going right for them. And just in August, President Trump signed that new defense authorization bill, which has a whole lot of spending for these little types of drones. So that was a nice catalyst for them. They also had a huge earnings beat. That's been driving the stock higher. And margins have been up huge, mainly because they've been focusing more on higher margin products. So their gross margins had a huge bump up in the last quarter. So. And the last thing is just what I mentioned real quickly is their balance sheet is fantastic. I mean, they have $280 million in cash, or it's about $12 a share with no long-term debt. So it's a pristine balance sheet. It's really that's a really nice aspect to the story.
Yeah, I'm just taking a look at their quick ratio, which is running at about 9 times, and their current ratio, which is 10.1 times here. So pretty attractive there.
Yeah.
How about their valuation? I mean, the forward P certainly looks a little frothy, but
it is for sure.
The proper way. I mean, would we be better off looking at like an enterprise value to free cash flow, considering how strong their balance sheet is?
Yeah, normally I would say I like the EV to EBITDA because that kind of takes in the balance sheet, the business, and they divide it by how much cash they're generating. I don't have that figure right in front of me at the moment, but that's something I look at, or PE is another thing I look at as well. But I think it's trading more on sentiment than it is necessarily. I don't think valuation is the most important thing here. I think it's mainly on sentiment. Mainly that defense bill is also being picked up as a 5G play because they recently signed a joint venture with SoftBank to fly. Basically, it's like a solar airplane that flies at like the edge of the atmosphere, and it's going to beam down 5G connectivity. So it's just a small part of the business right now, but as 5G technology takes off over the next 2-3 years, AVAV is going to be kind of seen as a play on that. So I think that sentiment also is kind of boosting the stock. But so just all that together is what's moving it.
Yeah, that was something I was unaware of. I've been following this name for a little while, and that SoftBank partnership with that 5G play I've found very interesting because obviously the small cells is going to be a big growth generator for the 5G, and this kind of takes off some of that. I'll be curious to see. I'd like to read a little bit more about it in terms of, because obviously those small cells are being placed on all the towers and everything around the country. And this is an interesting way around it, but you'd also have to think there's got to be some sort of standard for flying drones around with these small cells, right? But I mean, they're talking about flying them at pretty high levels, like kind of out of the atmosphere. Right?
Yeah, they're staying right at the edge of the atmosphere, so that's really high up. I mean, I don't really understand all the technology, to be honest. I just kind of, but I know they are very excited about it. I mean, they think it's a really potentially breakthrough technology with 5G. So, again, it doesn't really generate much revenue at this point, and it's also just a joint venture, so they don't own all of it. So, but it is, I think that will impact the trading in the stock over the next couple of years. As 5G starts to roll out, they'll start to be picked up as a play on it. So anyway, it's just a name to keep on the mount. I'm not sure I would chase the stock up here. It's up so much. But it's funny, I said that when they entered our rankings on Tuesday, and it's already up 7% from then. So,
yeah.
You keep waiting for a pullback where the stock keeps going. But still, I'd be a little cautious about chasing it up here. But I just wanted to mention it because it's a new play on emerging growth this week.
Yeah, no, and just so people are aware, it's only a 21 million float, so this volatility shouldn't be all that out of the ordinary. About 11% is short. Do you follow KTOS at all, Robert?
I'm vaguely familiar with it. I don't really know it as well. My sense is that AVAV is a higher quality name. I know they're both in the same drone space, but AVAV I think is just kind of it's just a better known name as far as I know, but I'm not too familiar with the other one.
Yeah, I mean, I'd like to do a comparison on it on the valuation. The KTOS probably hasn't gotten as frothy as AVAV, but there's obviously a premium being put on that AVAV, and that balance sheet certainly doesn't hurt things, right?
That's true. That balance sheet is fantastic. And also just the defense bill they have a big boost in spending for these types of drones next year, so that'll be a nice tailwind, pun intended, for AVAV.
And I'd never like to speculate on this, but given how healthy that balance sheet is, would you view this one as a possible M&A target for people?
Yeah, actually, I would. I could see a company like, an L3 or a huge defense
UTX or something.
UTX. I would not be surprised to see them come in, not just with the balance sheet, but also this is a nice niche. I mean, AVAV is a dominant player in their niche in the small drone space. I could see a larger company just buying them outright. I wouldn't be surprised with that. I mean, I'm not advocating that. I'm not saying that is necessarily what's going to happen. But
Right.
I think it's definitely a possibility. It would make a lot of sense. And the balance sheet is very attractive to companies as well, I'm sure.
All right, so let's move on to the next name, Robert. I'm going to introduce it to you, and then you could give a rundown of exactly what they do. But that's going to be Duluth Holdings, ticker symbol DLTH. I'm sure a lot of people have seen the commercials for the company, but why don't you run down and give people a little bit more of a background of exactly what they do?
Yeah, this was the other new ad in our market growth rankings this week. So basically what they do, they actually trade under, they're called Duluth Holdings, but you'll see all the commercials for Duluth Trading Company. That's the brand they use. So basically it's a rapidly growing apparel brand. They do like casual wear, work wear. What stands out about them is their advertisements really kind of funny. You'll see the guy in the cartoon where his underwear's a little uncomfortable, and so he puts on the buck naked underwear from Duluth, and he's really comfortable. He starts dancing around, and so there's just silly things like that. And there's like plumber's butt fix. So there's that. So they have these long tail T-shirts, things like that. So it's basically just known for really high quality workwear that a lot of tradesmen use. But there are a couple of big growth strategies that's going to hopefully get them to the next level. One thing is they're branching out their men's business to new categories like business wear, outerwear, footwear. Those are new areas for Duluth, and they're building out that. They're also building out their women's business, which is another thing. It was launched in 2005, and it's been just a small part of the business, but it's grown from just in the 1 or 2% range. It's up to about 23% last year, and the first year, half of this year, it's 27% of total sales. So Duluth is really excited about their women's business growing, and they're throwing more ad dollars on that side of the segment, that side of the business. So they see some good potential there. And just the final thing I want to mention is they're also doing a lot. They're really ramping up their new stores. They used to be completely online and in catalogs. They might open up like a store or two a year. I remember a few years ago when we started watching them. If they opened up 2 to 3 stores, that was kind of a big deal. And I remember them being at like 7, 10, and now they're opening up 15 a year. So that's a good sign as well. I think they ended fiscal 16 with 16 stores and nearly doubled that in 17 to 31 stores, and now they're going to do another 15 in fiscal 18 this year. So they should end this year at around 46 stores, which is huge. So they're really kind of getting out that brick and mortar aspect to it, which I think is good. A lot of their sales are coming from the brick and mortar side. I mean, the online is important, but getting the brick and mortar presence also kind of boosts their brand and gets them better known with customers, and it also gives customers a touch point with the brand where they can come in and test the product, feel it with their hands, return items if they want to. So it kind of gives more of a physical presence, and I think it's a good thing. So anyway, overall, I like Duluth. I think it's attractive early stage retail growth story. Again, it's a unique brand. It's a name we followed since the IPO years ago, and I think it's a little bit stretched here because they had that big bump on earnings, but on a pullback, I think it's a name to certainly consider.
Well, it's kind of interesting that you mentioned that because they reported on September 5th, right? And we saw that breakout above the 30 level, and it rallied to about 35.68 on September 8th. But we have seen a pullback and give up some of those gains here as it's dropped about 12% from that to come down to that 31.70 area. Of course, this is setting up for key support for the name. Here's one thing that I'd be curious about, and if you don't know the answer offhand. So just looking at the makeup for Duluth, they got only a 9.9 million float, obviously a pretty low float. 46% of that short. What is the focus of these short sellers? Usually when you see a story like this, certainly could be valuation. I'm looking for P's 31 times, price to sales 1.99 times. So I don't think that the valuation isn't that out of whack. What would the concern be for investors, and why this has such a high short interest? Would you know?
I'm not really sure. I mean, well, first thing off the top, I don't always trust those short interest ratios. If you go to Yahoo Finance, it's one number. If you go to FactSet, it's another number. I'm not 100% sure that 46% is correct, but but assuming that it is, I'm not really sure what the negativity is here. I mean, they're profitable, they have good growth, they're just building out their stores, and maybe it is the small float, and it doesn't take much to have a high short interest if you have a small float like that. But nothing really jumps out at me as something that's a really big negative about the story. But perhaps I'm just missing it, but I'm just not seeing a huge negative to the story.
Oh yeah, no, I trust you, and I know you do a good job at combing through these balance sheets, and you've been doing it for 25 years or so. So, but I always find it curious when the short interest is this high, and not saying 46 is exactly right, but I mean, I think it's fairly safe to say that it's pretty high. I don't think they're going to be 46% off. I'm just curious at what could people be seeing? Because I agree with you. Taking a look through it, I don't really see anything. I mean, the valuation's a little expensive, but I mean, it's not that frothy. So
I'm not really sure. I mean, they're an apparel company. I can understand if maybe some people know they might, if they're a software company, they might lose out on a deal or something like that. They might fall through. But they're just, the business is pretty simple to understand, in my view. And
it couldn't be that they're overstretched on debt at all or anything, right?
No, they're fine on debt. I mean, it's they're doing it. They're building these stores. I mean, they took a few years to start really ramping up. So so you can tell, it tells you it's like a cautious management. So they just basically want to slowly roll it out, and they're getting good at running the stores, and now that's why they're ramping up the number of stores out there. So, but that doesn't strike me as a big negative. I mean, perhaps I'm missing something in the story, but I don't think anything like that is too worrisome. I mean, the valuation obviously is up there. That would be probably my main concern with it.
And I see the gross margins, correct me if I'm wrong, are running around 55%. That's pretty high for a retailer, right? I mean, most retailers I would have pegged in that 30 to 40% area.
Yeah, I would say so. Yeah, no, I would say so. I mean, it's a little bit higher because also they do, well, it might be because a lot of their sales are still online, and so those are going to be higher margin sales than brick and mortar sales, I'm sure, because they don't have to, if you were to take all their sales divided by all their fixed costs of, rent, insurance, lighting, they don't have as big a percentage as other stores do in terms of, having the product out on display, because a lot of I think 40% of their revenue is still online. So that's a big chunk of their business. So maybe I think that might be why the gross margin is, just off the top of my head. That's kind of what I would think.
Okay, fair enough. All right, let's take a look at the last name you have here. Now, this isn't a GrowX name. Like you said, this came in at number 1. This was just added to the yield list?
No, it's been on the yield list for some time, but it's number 1 this week. So I wanted us to touch on it. It's on the yield leaders. This yield leaders is a report that comes out on the BitPlus product every Friday morning, and I really like this report because it finds good stories that are good fundamentally, and they also have a good income component, meaning they have either a good dividend, but more importantly, they have a big share buyback position, and that's what's really kind of boosting Brinker to number 1, is because there's a huge amount of share buybacks. And to me, that's, management putting their money where their mouth is. Management can easily say our stock's undervalued, but until they're actually buying shares out in the open market, to me, that's the best indication that they really think their stock is cheap. And Brinker's been very aggressive in that sense, so that's a big reason I like it. There are other reasons as well, but
so with it, what are some of the key stories for Brinker?
Yes.
Keeping an eye. Ticker symbol again for everybody, EAT. We have this up on the page right now.
Mm-hmm. So basically, their flagship brand is Chili's, obviously, Bar and Grill. They have 1,600 plus restaurants. They do have some Maggiano's, Little Italy, but Chili's is that's their flagship brand. That's going to be the vast majority of their revenue. So the stock is kind of in turnaround mode. The company, casual dining traffic has been softening in recent years, which has led to sluggish sales for a bunch of casual chain restaurants, and Eat is no different. So they've been hurt by that. So what they've been doing is taking steps to turn around their menu. First of all, they've reduced the menu by like 40%. So it's not quite as cumbersome as it used to be. They're putting a big focus on burgers, ribs, fajitas. And they're just improving their service. They're getting around quicker. They have that 2 for $22 meal. They also do a 3 for $10. So they're just getting their menu in better shape that would attract sort of a value customer. And the reason I like it, obviously aside from the huge share buybacks, is that I think that the next few quarters might be actually quite good, because they're lapping, basically when they started putting this new strategy into place. It was about a year ago now. So the September quarter of this year shouldn't be as big of a hurdle when they report results, probably in October sometime. So that could be a possible catalyst. They also have a nice dividend in the 3% range, 3.1%, something like that. So just overall, I just think it's a good turnaround play. So yeah, for Darden, I don't follow them as closely, but for them, I would basically just kind of what their just casual dining traffic is generally. It would be a good indication as to what Brinker might expect when they report in a few weeks from now, probably in October. Just the overall sense of, are consumers spending? Are they going out? In that sense, but their concepts are a little bit different. Chili's a little bit different than Darden, but overall, I think that the main thing that I would take from it is just sort of the overall traffic trends. I think that would have an impact on Brinker when they report. Oh, sure. Yeah, it's been a while since I've looked at that one. That's actually been a really nice mover. It joined our rankings April 9th at 2755. So it's been a nice mover for them. It certainly has pulled back in the last few weeks or so. I haven't really been on that last conference call, so I'm not exactly sure what caused that recent pullback, but I do like the story generally. They're basically just a play on basically do modular power components, and as consumer products get more advanced, they need more and more of products that Vicor sells, that kind of thing. So I think I do like the story overall, but that's a thin stock, so I'd be careful with that one. It has been a nice mover for us, but it is going to be volatile, and I would probably use a 10 to 15% stop loss limit. But overall, I do like the story still.